Are you rethinking some of what you said in the past about the likelihood of recession?
I think it is good news, and the evidence that there's been some wage restraint is part of the good news. But at the same time, I think one has to be careful of false dawns. And if you think about it, the good news was inflation running in the sixes, and that's still inconceivably high by the standards of 2 or 3 years ago. So I would stick with my view that a recession this year is more likely than not. But certainly looking at some of these trends, one has to think that the Fed's job is much, much closer to being done, feels much, much closer to being done in terms of disinflation than it did a few months ago. And I think the more optimistic possibilities, while they still would not be my bet, look more plausible today than they did several months ago. And that's got to be encouraging. We'll have to be watching the data very, very closely. And the most important day of this month, by far, from a macroeconomic point of view, will be the last day of the month when the employment cost index comes out. That's the gold standard measure of labor costs and wage pressure. And that's a number they'll be studying very, very closely at the Fed, and I suspect on Wall Street. And I'll certainly be up early that morning to get that number.
So right after that, actually early in February, we're going to have the meeting of the Federal Reserve. Given where we are right now, and it's always data dependent, should they at least be talking about a pause, if not in February, coming after that?
I think we're still not quite at that point. I don't think a pause in February would be well advised, and I don't think we have to make a definite decision beyond February for right now. Again, I think the most important thing is to make sure that the job of containing inflation gets done, and that they preserve their credibility. So I think it's a little bit premature at this point to be thinking about pausing, but we're getting much closer to that day.